Welcome to the On the Charts podcast, episode 179 for Wednesday, 19th of April 2017. The big news last night was the snap election called by UK Prime Minister Theresa May, which caught almost everybody by surprise. The FTSE promptly fell 2.5% and the pound rallied 6% on the news. This now sheds more doubt on elections across Europe, with France this weekend and Germany also not far off. And the main focus for US traders, that aside, is the current earnings season, which is starting to gather steam, but got off to a rather poor start last night. Goldman Sachs missed its mark, as did Johnson & Johnson. Goldman's fell almost 5% to its lowest level since early December, and we should remember that it was one of the leaders from the Trump bump. Johnson & Johnson fell about 3.5%, but managed to close well off its session's lows. And the Chinese stock market has been losing some ground over the last week and becoming somewhat shaky for commodities. The Shanghai Composite is down some 5% in the past week. Last night, commodities took a hammering on the back of it. Aluminium fell 1%, copper was down 2%, nickel dived 4.5%, and lead sunk 6.3%. There were some decent moves in the currency as well. As mentioned, the Aussie dollar losing ground after trading back in the mid-75 range. At the close, the S&P was 0.3% lower and the Nasdaq slipped 0.1%. In Australia today, we saw an almost perfect reversal of yesterday's form by many stocks. The much-thwarted telcos found a bid. Vocus rose 10% after yesterday's falls. TPG added 6.7%. Telstra even strengthened 3.25%. Brambles was also a standout today, adding 6% after it announced some new contract wins in the US market. Brambles has slumped some 30% so far this year, but it's difficult to see if this news creates a major turning point in the longer-term trend. Weak oil prices last night also weighed on energy shares today. Oil Search fell 2%, Woodside slipped just a little over 1%. Whitehaven continued to dip and is now back on the range where it spent most of the last 6 months, and the next stop for Whitehaven is the major support down around $2.60. At the close, the ASX was 0.6% lower, a little off the day's lows. Looking at a few charts of interest, Flight Centre, which is engaged in travel retailing, wholesaling and the corporate travel market management. The company operates internationally, including throughout Australia, US and the United Kingdom, to name a few. For the 6 months ending 31st of Dec, revenues decreased 1%, net income decreased 36%, and the net income also highlighted the communication and IT increases of 22% to $45 million. Brokers are on the fence, currently suggesting the stock is a hold, and the dividend yield is 4.9%. Now, there are reasons to be cautiously optimistic long-term. International departures have increased 5% in February, while leisure grew at 3.9%. Management continues to focus on cutting costs, and a small acquisition in India offers exposure to a fast-growing emerging travel market. Bottom line is the company is in a strong position to grow earnings over the longer term. Now, technically, the chart doesn't look overly impressive on first sight. However, there's two traits that suggest a low may now have been locked in and a more sustainable bounce would be unfolding. Firstly, there's a significant level of support, or a zone of support, around the $29 level that has held prices since mid-last year. Whilst there's been probes to the lower side of this range, it's been met by solid buyer demand, namely rejection of the weakness and higher volumes. The second trait is the fall into this support zone has been weakening. Specifically, each leg down has occurred on a softer trajectory, which in turn has created what's called a large falling wedge pattern. This wedge has now broken to the upside, and typically we would see prices reverse course back to the starting point of the pattern, which in this case is around the $38 level. Any small or low volume dips here could present a buying opportunity for that swing higher. That said, there needs to be further evidence to build to suggest any sustainable trend is going to start to commence. Another stock of interest is Evolution Mining, which owns 5 gold and silver mines in Queensland and Western Australia and retains 100% interest in all of them. The outlook looks promising with debt repayments ahead of schedule, strong free cash flow. Gold hedging is in position which secures strong margins for part of production, adding cash flow security. Looking at the weekly chart, shows a correction terminated at the typical retracement zone, which under normal circumstances would be extremely bullish. However, the problem here is the time taken for that retracement to occur. It really doesn't show clarity or clarity with a prior trend higher. A retracement should ideally take about 38.2% of the time taken by the prior trend, and that hasn't come close as yet in this area. As such, the door is wide open for a larger and possibly more complex correction to take hold, which could still take quite a number of months to unfold. We continue to hunt for opportunities within the gold sector, although almost every chart we cover suggests more time is required before the strong prior uptrend kicks back into gear. Over the short term, there's every reason to expect that stocks like Evolution will probe higher, but without a low-risk entry, plus limited upside potential. There's no real rush to get in at this stage. If we're correct, then more patience is going to be required, although the patient investor could be very well rewarded over the coming years for those gold stocks. My name is Nick Radge. I look forward to seeing you on the charts tomorrow.